Hello everyone. In this video we are going to discuss various accounting terminologies, difference between bookkeeping and accounting, users of accounting information and various source documents. So we are beginning with the most important accounting terminology without which we cannot prepare the books of accounts. The first terminology is capital. Capital means the amount invested by the owner of the firm into the business. So the amount which is invested by the owner into the firm is known as capital. It means the amount in terms of money or assets having money value, which means if the owner has brought cash into the firm, so it would be the amount of capital. If he brings the furniture into the firm, if he brings building to the firm, if he brings machineries to the firm, all such assets, all such resources which are having the money value with them will also be a part of capital which the proprietor has invested into the firm. For the firm, capital is a liability towards the owner. It is the obligation which is created towards the firm. The firm has to pay back the amount of capital at the end of the life of the business. Next very important term that we are going to discuss now is liability. Now liability means the amount which firm owes to the outsiders except the proprietor or the owner. Now if we talk about liability, liability is nothing but the obligation which is created. Now since we have just spoken about the capital, capital is also a liability. The firm has to repay back the amount of the investment made by the owner into the firm at the end of its life of the business. It has to pay back to the owner. So if we talk about liability as a whole term, we can say the liability which is created towards the owner is known as capital. The liability which is created towards the people other than the owner is simply termed as liability. So we can divide the concept of liability in external liability and internal liability. External liability is the obligation which is created. The firm has to pay the money back to the people who are outsiders, right? And if the firm has to pay back money to the owner, we do not call this as a term liability, but we call this as capital. So the claims of those who are not the owners are called liability. And we have also shown you the liabilities is equal to assets minus capital. So long-term liability and short-term liability. So here in the books of accounts, when we talk about, here in accounting when we talk about, there is simple bifurcation about long-term and short-term. It is very simple. So if anything which is being used, which is to be repaid within 1 year, within a period of 12 months, it would be short-term. Anything which is giving us benefit or which is to be repaid beyond 1 year, after 1 year, it becomes long term. So 1 year is the demarcation line for this, correct? So here when we talk about long term liability, these are the liabilities, these are the obligations which are created by the firm, which are to be payable, which are payable after a long term. That means after 1 year's time, which means long term loans, loans which are to be paid back after 1 year. Debentures, bonds which are to be paid back after 1 year. Short-term liability, now these are the obligations which are there and these are to be paid within 1 year, within the period of 12 months. So for example, we have creditors, we have the suppliers, we have the vendors from whom we have taken the goods on credit. So we need to pay them back as soon as we have money with us, right? So bank overdraft, with this is over withdrawn money from the bank. For example, if I have 10,000 rupees in my bank account but I need 15,000 rupees, I would request bank to provide me overdraft facility against a fee. So what bank will do? Bank will give me 15,000 rupees, 10,000 from my account itself and 5,000 from the bank. And this 5,000 would be taken as loan for me and I have to pay back the interest on the 5,000 rupees till the number of days I have used it. So this is bank overdraft. Now bill payable. Again, the bill of amounts which are to be paid by the firm, bills payable. Short-term loans. Again, these are loans from the financial institution which are to be paid back to them within 12 months of time. So these are short-term liabilities. So liability, long-term liability and short-term liability. Then we have assets. Now assets are nothing but the resources which help the firm to get the benefit and generate revenue. So these are the resources which help to get the revenue generated. Anything which enables a firm to get cash or benefit in future is an asset. Assets are future economic benefits which are owned and controlled by the organization or individual. Now, money owing to debtor. Owing by debtor, that means if we have sold goods on credit to a customer, now customer has to pay back money to the firm. So this is money owing by debtors. Stock of goods, cash, furniture, machines, buildings, all such things are assets because these would provide benefit to the firm in the future. Now the way we have segregated the liabilities into long term and short term, we can here categorize the assets also into long term or short term. Now long term assets are also known as fixed assets. These are those assets which provide the benefit to the firm for a longer period of time, for more than 1 year. Those assets which are purchased for the purpose of operating the business, not for resale. For example, land, building, machinery, furniture, motor car, etc. All such assets which are longer period benefit, which are providing longer period benefit, are long-term assets. So when we talk about short-term assets, these are those assets which are kept for short term, for converting them into cash or for resale. So you can simply bifurcate the long-term or short-term assets. If assets are purchased for resale, that means these are short-term assets. If it is there for providing benefits for a longer period of time, not for the reselling purpose, becomes long-term assets. So short-term assets are the assets which provide the benefit within 12 months period. For example, unsold goods. So these are the unsold goods or stock if we talk about. So nobody wants to keep the stock in the firm more than 12 months of time. So the intention always for the management and intention always of the owner is that to sell the stock as soon as possible and get the cash, get the profits. And therefore the stock or the unsold goods are short-term assets. Debtors, these are the customers who have purchased the goods from the firm on credit. So they are going to give us the cash back. So therefore the debtors are short-term assets. Bills receivable, these are the amount of bills which are to be received. Then bank balance, always bank balance would be a benefit for the firm. So all such things, all such items are short-term in nature. Then we talk about revenue. Revenue is total amount of money received by the company for goods sold or services provided during a certain period of time. So the amount of money that we realize after sales during the year. So we calculate the amount of units sold and the amount of the price with which we have sold the units. We can easily calculate the amount of revenue which is generated during the year. So there is a difference between income and revenue. Income is revenue minus the expenses. Revenue minus the cost which is incurred to produce that revenue. So income is a profit. Revenue is the amount which is realized from sales. Then we talk about expenditure. Expenditure is any amount paid for increase in assets of business. For example, raw material for business, furniture for business, etc. So, incurring a liability or disbursement of cash for the purpose of obtaining assets, goods or services, this is an expenditure. The benefits derived from incurring an expenditure can be for a longer period of time. So, the amount incurred in the firm for longer period or for shorter period, both are expenditure. Now we can see the categories of expenditure. We have three categories of expenditure: capital expenditure, revenue expenditure and deferred revenue expenditure. Now capital expenditure, it is incurred for obtaining a long-term advantage. So if the firm is investing the money in buying the long-term assets, this is known as capital expenditure. Revenue expenditure is short-term in nature. If we are paying the expenditure to get the short-term benefit, it is incurred where benefits expire within a year or which has been incurred merely to maintain the business or keep the assets in good working condition. These are revenue expenditure. For example, paying salaries to the staff, getting the services of the staff and paying them salaries, paying rent of the building, so getting the services of the building and paying rent against the same, then paying repair and maintenance expenses, so getting the repair and maintenance services and paying the repair and maintenance expenses. So this is revenue expenditure. Simple terms, we call revenue expenditure as expenses. Then third category, which is deferred revenue expenditure. It is incurred but carried forward on the presumption that it will be of benefit over subsequent periods. So these are basically the amount of expenses, amount of expenditure which is incurred once and get the benefit for a longer period of time. But the difference between capital expenditure and deferred revenue expenditure is capital expenditure is the investment of money into long-term asset. If we sell the asset, we get some amount, we get the realizable value. But if we talk about deferred revenue expenditure, this is also investment for a longer period of time, but we are not buying the asset here. If we want to sell the deferred revenue expenditure, we will not get any money out of it. So if I give you an example, establishment charges, incorporation expenses which are incurred at the time of incorporation of the company. So these are the expenses which will provide benefits for a longer period of time. But these, if we resell the expenses, we resell the documents, we will get nothing out of it. So therefore, if the expenditure do not have any resale value, any realizable value, that comes under the category of deferred revenue expenditure, and this deferred revenue expenditure is also known as fictitious assets. Then we talk about expenses. It is nothing but the revenue expenditure that we are talking about here now. It is the amount spent in order to produce and sell the goods and services which produces the revenue. The benefits derived from an expense are consumed in the same period. For example, payment of salaries, rent, etc. So this expense is nothing but the revenue expenditure. Services taken, payment made. Benefit taken, payment made. Consumption of the benefit is done in the same period and the amount against that is paid. So that is expense. Then we talk about purchases. The term purchases here, the term, if we talk about purchases, we can use this term for any purchase, right, in the normal life. But when we talk about books of accounts, this is a technical term. So when we record the transactions in the books of accounts, we use this purchases term only for purchase of goods, not for any other purchase of asset. So if suppose I am dealing with toys, I am a manufacturer of toy, and I am purchasing the stock of raw material for manufacturing toys. So the stock of raw material for manufacturing of toys would be called purchases when I will purchase this, right? And the purchase of furniture, purchase of building, purchase of machinery, etc. will not be termed as purchases here. We have to specifically mention that it is a purchase of building, it is a purchase of furniture, it is a purchase of machinery in the books, right? So don't get confused, students, between the term purchases. If only purchases is mentioned, that means we are talking here about the goods, the stock. Okay. So goods are those things which are purchased for resale or for producing the finished products, which also meant to be sold. So purchases include both cash and credit purchases of goods. Similarly, the term sales. The way we have used the term purchase is only for the purchase of stock. We use the term sale only for the sale of stock or sale of goods, nothing else. So if we are selling furniture, if we are selling machinery, if we are selling building, if we are selling any other asset that is there in the firm, we are not using the term sales. We will only use the term sales when we are selling out our finished goods. It may be toys, it may be clothes, anything in which we are actually dealing in. So the sales include both cash and credit. Payment which is not received at the time of sale, which is a credit sale of goods. Okay, so we have heard a lot of time the term stock. What is stock now? Stock includes unsold goods lying in the firm on a particular date. So goods which are sold will not be in the ownership of the firm. So we are only calling stock for those items, those goods which are still to be sold, which are unsold till now, and these are lying in the firm. These are stock of goods. And stock can be opening stock, stock can be closing stock. Closing stock and the opening stock based on the period at the point where it is lying. That means goods lying unsold in the beginning of the accounting year is opening stock. The goods lying unsold at the end of the accounting year are called closing stock. Then we talk about debtors. A person who owes money to the firm mostly on account of credit sale of goods is called debtor. Receivables may be in the form of bills receivables or any other form except in the form of debtors. The amount due to business entity from outsiders which are not included in debtors are covered under this head. So these are the two terms, debtors and receivables, which are created when there is credit sale of goods and amount is still pending to be received. So if it is only invoice based, we call these debtors, the customers, as debtors. And if there is a legal agreement which is signed between the two parties, we call this bill of exchange, and then we call these as bills receivables. Similarly, we have the term creditors and payables. So, a person to whom money is owing by the firm is called a creditor. Now, this creditor is nothing but the vendors or suppliers who have given us the goods on credit, who have given the firm goods on credit. That means debtors, what we did is we have sold the goods on credit. In terms of creditors, what we have done is we have purchased the goods on credit. And payables are nothing but if they have both the parties have entered into a legal contract and bill of exchange is signed, so we call this as payables, the amount of bills which are to be paid. Then we have the term drawing. It is the amount of money or the value of goods which the proprietor takes for his domestic or personal use. So I have talked about the first terminology, which is capital. So capital is the investment of money from by the owner to the firm. Now if owner withdraws money from the firm for his personal use, that amount of money which is withdrawn from the firm is known as drawing. So students, you need to be very careful. If it is only mentioned that it is being used for personal use, private use, domestic use, then only we call the term drawing. Otherwise, if it is for official use, it will not be drawing. Be careful. Then we talk about discount. So discount is an allowance or reduction allowed from an amount due to the amount due is termed as discount. So we have seen in our daily lives that discount offers. So this is nothing but the reduction in the value. So we can categorize this into trade discount, quantity discount, and cash discount. Trade discount, it is a deduction allowed to the buyers from the gross or the catalog price. That means MRP. If they have the deduction from that, this is the trade discount on account of the trading activity which is there. Quantity discount, the deduction or the reduction allowed to the buyers from the gross or catalog price on making the bulk purchases. So if the trader is able to negotiate the price based on the quantity that he is buying, that would be called quantity discount. Cash discount, when there is a prompt payment made by the buyer. So that would be called cash discount. In a practical scenario, what we can do is trade discount and quantity discount can be clubbed together, and whenever negotiation happens by the trader, so trade discount is there, and this negotiation is also get mixed with the quantity. They negotiate on the quantity which is to be purchased. So therefore these two categories are clubbed together. We have then the terminology which is now we have is the trade discount and cash discount. Next we talk about are the source documents. Source document is the original document that contains the details of a business transaction. A source document captures the key information about a transaction, such as the names of the parties involved, amount paid, date, and the substance of the transaction. Source documents are frequently identified with a unique number so that they can be differentiated in accounting system. The pre-numbering of documents is particularly useful since it allows a company to investigate whether any documents are missing or not. Once the information in a source document has been recorded in the accounting information, the source document is indexed for easy access and archived. Documents generated within the past year are generally stored on site, with older documents being stored in less expensive offsite storage facilities. These source documents are critical for the auditors who use them as evidence that recorded transactions actually occurred. So in the last video we discussed about objective evidence concept. So these are the source documents which are to be provided to the auditors for authenticity of the transactions. So a source document is also used by the companies as proof when dealing with their business partners, usually in regard to payments. Examples of source documents are cancelled checks, credit memos, deposit slips, expense report, invoices, material requisition forms, purchase orders, time cards, and sales receipts. For evidentiary purposes, electronic images of source documents are generally acceptable, though paper-based documentation may still be required in some cases. Okay, so in the first video, we have talked about users of accounting information. These are the various parties who are interested in the accounting information. So these are owners of the firm, management for decision making, investors for further investment into the firm, creditors and financial institutions for credit to be given to the firm, credit related to the raw material, and financial institutions related to the loans to be given to the firm. Employees and trade unions for their future stability and security. Government for taxation and other regulatory compliances. Researchers for future researches and developments. Public, general public for their own interest in the firm. Now we talk about bookkeeping and accounting. So in the first video, when we're talking about the accounting as a process, accounting as a language, so we were discussing what bookkeeping is. So here is the difference between bookkeeping and accounting. So bookkeeping scope is narrow. It is a part of accounting, wherein accounting is a broader term that includes bookkeeping. So when we talk about decision making, data is provided by bookkeeping, not help in decision making. Whereas the accounting data helps in decision making, it can be done using information presented accounting records, which are financial statements. So when we talk about financial statements, the third point, the process does not involve preparation of financial statements. Bookkeeping only is limited to recording of the facts. When we talk about accounting, it is the preparation of the financial statements, and there is not any specific skill which is required, and simply a person who has a skill of recording the journal entries and preparing ledger can easily do bookkeeping. However, in terms of accounting, special skills are required and the knowledge of analysis is required. Person involved, person performing this job is known as bookkeeper or clerk. The person performing the books, preparing the financial statements, doing the job of accounting is known as accountant. And nature of job, the bookkeeping is clerical in nature, accounting is professional in nature. I hope you all have understood the difference between bookkeeping and accounting. I hope you have learned a lot in this video, and I would say all the best to all of you. Thank you so much.